Let's talk about something that hits us all: energy prices. Whether you're filling up your car, paying your electricity bill, or just trying to budget for groceries, the cost of energy is a constant presence in our lives. It's not just a number on a sign or a line on your bill. It shapes how we live, work, and move around every single day. In 2026, the big story is an oversupplied oil market, 6 years running. Oil producers around the world have been pumping out more oil than ever, and storage facilities are brimming. Tankers wait offshore, and oil fields keep humming, all contributing to a global glut that's hard to ignore. There's simply more oil than the world needs, keeping prices capped and stable. Refineries are operating smoothly, warehouses are full, and the usual price spikes just aren't happening. For consumers, this means less volatility at the pump and more predictability in monthly expenses. After an 18% drop in 2025, there's no strong reason for a price surge this year. Analysts are watching closely, but the data points to a market that's calm, even after last year's dramatic fall. Investors and everyday people alike are breathing a little easier. The fundamentals, supply outweighing demand, are driving this trend. Pipelines are moving oil efficiently, but there's just not enough demand to soak up all that supply. This basic economic principle is shaping everything from global trade to your local gas station. Think of it as a scale. Production is much heavier than demand, pushing prices down. Imagine a seesaw where one side is loaded with barrels of oil and the other side, representing demand, just can't keep up. The result? Prices stay low and the market remains steady. We'll explore why supply is so high and demand is so soft. From new drilling technologies to changing consumer habits, there are many reasons behind this imbalance. Fewer cars on the road, more efficient engines, and alternative energy sources are all playing a part. This means your next fill-up should be less painful, and the market stability is likely to continue. For families and businesses, this offers a rare sense of relief, at least for now. Lower prices at the pump can free up money for other needs, and steady markets help everyone plan ahead. But this isn't just about cheap gas, it's about a world in transition. The rise of electric vehicles, renewable energy, and new government policies are all reshaping the energy landscape. Oil is still important, but it's no longer the only game in town. The old rules of the oil market are changing, shaped by new technology and shifting priorities. Automation, digital monitoring, and cleaner energy sources are making the industry more efficient and less dependent on old patterns of boom and bust. As we move through 2026, understanding this supply-demand story is key to seeing where the global economy is headed. The choices we make today about energy, technology, and sustainability will shape not just oil prices, but the future of our planet and our daily lives. So where's all this extra oil coming from? OPEC is gradually increasing production after pandemic-era cuts, flooding the market. New oil fields in places like Brazil, Ghana, and Norway are adding even more supply. If the Russia-Ukraine conflict ends, the war premium on oil could disappear, pushing prices lower. It's a perfect storm. OPEC's output, new projects, and possible geopolitical calm. The result? A river of crude, making a price spike unlikely. The world simply has more oil than it needs. That's the reality keeping prices in check for 2026. Now, let's take a closer look at what's happening with oil demand around the world. Even though there's plenty of oil available, prices could easily spike if people and businesses suddenly wanted a lot more. But that's not what we're seeing. Instead, demand has stayed surprisingly flat, and in some places, it's even dropped. Global demand is sluggish. Economic growth in many countries is slow, and at the same time, new technologies and stricter regulations are making everything from cars to factories more energy efficient. People are simply using less oil to get the same work done. China, which used to be the world's main driver of oil demand, is now cooling off. Its economy isn't expanding as quickly as before, and it's investing heavily in alternatives to oil like electric vehicles and renewable energy. As a result, China is using less oil than many experts predicted. This isn't just a temporary dip or a short-term trend, it's a structural shift in how the world uses energy. The changes we're seeing are likely to last for years, if not decades. Cars are getting more miles per gallon, industries are finding ways to cut back on power, and governments everywhere are setting ambitious targets to reduce energy consumption and carbon emissions. These efforts are making a real difference. The world is learning to do more with less oil, relying on smarter technology, cleaner energy, and better planning to meet its needs. So, even as economies continue to grow and populations rise, oil demand just isn't keeping pace the way it used to. More people are using public transport, and businesses are investing in efficiency. This weak demand, combined with a steady or even growing supply, is the main reason why oil prices are stable or even falling in many markets. The market is oversupplied because the world simply doesn't need as much oil as before. This new reality is reshaping the entire energy landscape. Digging deeper, China's electric vehicle EV revolution is a game changer. 60% of new cars sold in China are electric, bypassing gasoline entirely. This mainstream shift, backed by government support, is slashing gasoline demand. It's not just cars. Buses, vans, and trucks are going electric too. China, once the hope for oil demand growth, is now leading its decline. Oil producers are scrambling to adjust their forecasts. The old link between economic growth and oil demand is breaking. China's EV boom is a major reason the world is awash in oil. If prices fall too far, the oil industry hits a breaking point, around $55 a barrel for U.S. crude. Below this, drilling new wells becomes unprofitable, especially for U.S. shale producers. Companies cut back, cancel projects, and future supply drops. This self-correcting cycle creates a natural floor for prices. The pain of low prices forces supply down, stabilizing the market. That's why analysts don't expect a total price collapse. The $55 threshold acts as a buffer. Production costs set a limit on how low prices can go. Even in a glut, this dynamic keeps the market balanced. Here's a surprise. Even if oil prices stay flat or fall, energy stocks can still do well. In 2025, oil prices dropped 18%, but major companies like Exxon and Chevron held up. Why? The industry has shifted from drill to capital discipline. Now companies focus on steady returns, paying dividends and buying back shares. This makes energy stocks attractive even if oil prices aren't rising. Investors are buying into reliable cash flow machines, not just betting on oil spikes. The sector is more stable and predictable than before. For 2026, energy stocks remain a solid investment, even in a flat market. The business model has changed. Less boom and bust, more steady rewards. That's a big shift for investors and the industry alike. While oil prices may grab headlines, the real energy drama unfolding today is in electricity. The world is shifting its focus from fossil fuels to the power that runs our modern lives. Electricity is at the heart of this transformation. The explosive growth of artificial intelligence and the rise of massive data centers are driving a surge in U.S. power demand like never before. These data centers, filled with thousands of servers, require enormous amounts of electricity to operate around the clock, powering everything from cloud computing to streaming services. After decades of flat or even declining growth, electricity use is now rising at a pace of 2 to 3% a year. This may sound modest, but for a sector that's been stagnant for so long, it's a dramatic shift. In just 5 years, demand could jump as much as it did over the last quarter century. That's a staggering acceleration, and it's forcing the entire industry to rethink how we generate and deliver power. Utilities and power producers are now racing to build new power plants, expand renewable energy sources, and upgrade the aging grid to keep up with this unprecedented demand. Billions of dollars are being invested in infrastructure to ensure the lights stay on. Wall Street has taken notice, piling into utility stocks and seeing them as a prime way to invest in the AI revolution. Investors are betting big, on the companies that will power our digital future. This isn't just a short-term spike, it's a fundamental long-term shift in our energy infrastructure. The mix of power sources is evolving, with renewables, nuclear, and even natural gas all playing critical roles. The electrification of transportation and heating is adding even more strain to the grid. Electric vehicles, heat pumps, and smart homes are all increasing the demand for reliable, clean electricity. We're entering a new golden age for electricity, where utilities are becoming some of the hottest investments on the market. The companies that can adapt and innovate will shape the future of energy. The big energy story of 2026 isn't about oil anymore. It's about powering our increasingly digital, electrified world and the race to keep up with tomorrow's demands. The electricity boom brings higher bills for everyone. Building new power plants and lines is expensive, and utilities pass those costs to customers. Power prices are rising faster than inflation, squeezing household budgets. This is fueling public frustration and political pressure. Regulators may block rate hikes, slowing grid upgrades in some states. The need for investment clashes with the need for affordability. This tension is now a major policy debate. Investors cheer utility growth, but families feel the pinch. The shock isn't just to the grid, it's to our wallets. Pulling it all together, 2026 is a tale of two energy markets. At the gas pump, it's calm. Plenty of oil, weak demand, and stable prices. China's EV revolution is reshaping gasoline's future. Oil companies are adapting to a new era of discipline and lower growth. But electricity is where the action is. AI and data centers are driving a power boom. Utilities are booming, but so are household bills, creating political headaches. Regulators must balance investment with affordability. The energy conversation has shifted from oil to electricity and the grid. Understanding this pivot is key to grasping today's economy. The journey from fossil fuels to electricity is underway, shaping our lives every time we fill up or pay the power bill.